Why is it called a bull market? A bull market is a financial term used to describe a market condition where the prices of securities are rising or are expected to rise. It is typically characterized by a period of increasing investor confidence, optimism, and expectations that strong financial results will continue. Here's a detailed explanation of why it's called a bull market. Historical background and origin of the term. Symbolism of the bull. The term bull market is derived from the way a bull attacks its opponents. A bull thrusts its horns upward into the air, symbolizing the upward movement of the market. The image of a bull raising its horns represents the rising prices in the stock market. Historical usage. The use of the bull to describe rising markets dates back to at least the early 18th century. The term became widely used during the 19th and 20th centuries as financial markets became more established and sophisticated. Contrasts with bear market. The bull market is often contrasted with a bear market, where prices are falling or expected to fall. The bear symbolizes the opposite because bears swipe their paws downward, representing declining markets. Together, the bull and bear represent the cyclical nature of markets. Characteristics of a bull market. Rising prices. The primary characteristic of a bull market is a sustained increase in the prices of stocks, bonds, or other securities. This rise can last for months or even years. High investor confidence. During a bull market, investor confidence is typically high. Investors are willing to buy more stocks because they expect prices to continue rising, leading to potential profits. Economic growth. Bull markets often coincide with periods of strong economic growth, low unemployment, and high corporate profits. Positive economic indicators reinforce the upward trend in the market. Increased investment. More people are likely to invest in the stock market during a bull market. This influx of capital drives prices higher, creating a positive feedback loop. Speculation. In a bull market, there can be a high level of speculation, with investors buying assets not necessarily because of their intrinsic value but because they expect others to continue driving prices higher. Phases of a bull market. Accumulation phase. This is the early stage of a bull market when savvy investors start buying undervalued stocks. Market sentiment is typically negative, but prices begin to stabilize and rise gradually. Public participation phase. During this phase, more investors recognize the improving market conditions and start buying stocks. This leads to increasing prices and higher trading volumes. Investor confidence grows, and the media begins to report more positive news. Excess phase. The final phase of a bull market is characterized by widespread enthusiasm and often irrational exuberance. Prices reach unsustainable levels, driven by speculation and overconfidence. This phase often precedes a market correction or the beginning of a bear market. Historical examples of bull markets. Post-World War II bull market. The period following World War II saw significant economic growth and a long bull market that lasted into the 1960s. This era was marked by industrial expansion and increased consumer spending. 1982-2000 bull market. One of the longest bull markets in history occurred from 1982 to 2000. This period saw the rise of technology companies and significant stock market gains, particularly in the 1990s. Post-2008 financial crisis bull market. After the 2008 financial crisis, the stock market rebounded and entered a long bull market that lasted until the COVID-19 pandemic in early 2020. This period was characterized by low interest rates, quantitative easing, and technological advancements. Psychological factors in a bull market. Optimism. Investor sentiment is generally optimistic during a bull market. Positive news and strong economic indicators reinforce this optimism. Fear of missing out. As prices rise, more investors may enter the market out of fear of missing out on potential gains. This can drive prices even higher. Greed. Greed can play a significant role in the later stages of a bull market. Investors may take on more risk, assuming that prices will continue to rise indefinitely. Confirmation bias. Investors may seek out information that confirms their belief in the continuation of the bull market while ignoring signs of potential risks or corrections. In summary, a bull market is called such due to the symbolic upward thrust of a bull's horns, representing rising market prices. Bull markets are characterized by sustained price increases, high investor confidence, economic growth, and increased investment. They have distinct phases and are influenced by various psychological factors, making them a key concept in financial markets and investment strategies.